360. Now let's take a look at the bigger picture with David Stryzewski. I was practicing and I still screwed it up. David, he's here with me at the New York Stock Exchange. He's CEO of Sound Planning Group. David, it's so good to have you here. Thanks for being here with us.
Thank you for having me.
So I was going through, you sent a ton of notes over, and the two things that really stuck out to me are lower lows and lost decade. So let's start with the lower lows. You say 2023 will bring us lower lows as the Fed's inflicted recession hits our economy over the next few months. So how deep of a recession are you forecasting? How low can this market go?
Well, that's the million-dollar question, right? So, my vote is the world goes up forever, but we've just had the longest expansion on market history. And so as we look at 2022 and 2023, I do think that we are beginning to see perhaps the beginning of the new lost decade, which means that we might not return to this high again for another 10 years. How deep does it go? I think that depends on the Fed. It depends on how fast they're going to pivot. It depends on if we can get back to pumping some oil here and if we can get the real estate market turned back on again. But these things are kind of dead in the water right now. And so that doesn't give us a great outlook as we're looking at really the five things that move markets. We've got interest rates, inflation, what the Fed's doing about it, corporate earnings, probably going to see an earnings recession, and geopolitical events. In all five of those areas, I'm not really thrilled. So I think Jamie Dimon said it earlier this last year, that we're possibly facing an economic hurricane. And so one thing that I'd like to just note is that there's a difference between tornadoes and hurricanes. Tornadoes show up out of the blue. Hurricanes we see coming off in the distance. We see this tropical storm beginning to develop. And so I think in each of those five areas, we're recognizing there's some contagion, there's some challenges, and there's not one simple solution for it. But ultimately, I think that we are going to see lower lows, maybe 20, 30, 50%. Who knows? There's a best and a worst case for sure.
But all of those things that you mentioned, aside from an earnings recession, because earnings really kind of held in pretty well last year, but inflation, Fed interest rates, geopolitics, so many of those headwinds we faced last year, we've talked about. The Dow was down, about 8%? S&P was down 20%. NASDAQ was down 30%. Aren't they priced in at this point?
I don't believe that they are priced in at this point. And the reason for that is that we're not even getting clear directives from the White House or Powell that we're in a recession. 2 negative quarters of GDP was how I was taught that a recession was there. So I think we saw a mild recession in 2022 as we began to see these things happen. I think that we were reminded that bonds can also lose money, as bonds had their worst year in the history of Barclays Aggregate Bond Index. So the 60-40 portfolio didn't really balance us the way that we thought that it was going to. So as we see the earnings come down, well, we should also consider real estate. Every 1% that interest rates go up, the real estate market should actually correct by 10%. So we've seen a 4% interest rate increase. So every $1 million house is now worth $600,000 according to that simple math. But real estate's a lagging indicator. And so as we're seeing the air start to come out right now, as nothing's really moving right now, it's very difficult to buy or even rent for that matter. I think that we find ourselves in this really, really difficult position that we're seeing just weakness begin to show up today that was not necessarily here last year as things were just developing.
So if 2022 was the beginning of a lost decade, that means we still have 9 more years of this lost decade. So what do investors do? Where do they put money if the 60-40 portfolio is broken, if real estate prices could be coming down, and if stocks could fall double digits?
Yeah. So I look at, there's 3 attributes that an investment can have: liquidity, growth, or protection. And so I break those down into 3 categories: cash assets, protected assets, and risk assets. So our cash assets are liquid and protected. Think bank assets, okay? But you're going to go broke safely if you put everything there, right? Our protected assets are those bonds that we've been having some challenges with. Protected, you get a reasonable rate of return, hopefully, but there's no liquidity, or we have a reduced liquidity. And that's really the anchor that we were hoping that would really hold here during this time frame. And I think we've been left wanting. And then lastly is our risk assets, which can grow really well. Hopefully they're liquid so we can be dynamic. We need to be a lot more tactical here today. And then, of course, the downside is that we don't have protection. And so what we need to identify is the right balance of these things. And so I believe that people should be reallocating to treasuries sound great for cash, but they should have more today than they had in the past. Protected assets are important, but we need to focus on where are the right protected assets. And so there's a number of items in those that go beyond corporate debt, which, if I could be candid with you, I'm a little bit nervous about, because interest rates have risen so high, so therefore the cost of borrowing is difficult for expansion. Maybe even the real estate that these organizations own, the office buildings, are not going to be performing well. So I think we need to be more active in our outlook.
What about in terms of equities? If you're going to put money to work in stocks, what do you want to buy?
All right, so I'm a fan of energy right now. I think I'm a big fan of U.S. energy, but we're not there yet. I think energy is going to go up. I mean, God forbid we have a fire in one of these refineries or an oil spill. You know, that would be horrible. But it would cause the supply to even be lower. We're facing a serious diesel shortage right now. Gold and silver, I've been saying this all year, have been an important thing to be paying attention to. Now, if we look at last year's numbers relative to the US dollar, we'll think, oh, not a huge amount of movement. Look at it in comparison to the euro that lost 25%, and compare that to gold and silver. Now you begin to get a little bit different of a picture, while simultaneously China and Russia are buying gold by the tons right now. I'd say take a look at real estate in the right areas, maybe senior housing, medical buildings. We could definitely see opportunities in data centers, staging locations, you know, like Amazon might use in big storehouses. So there's a number of ideas out there, as well as defense contractors, as the world's heating up in more of a military way, which of course we just hope peace is forever, but the reality is there's a lot of preparation taking place, and the United States makes better weapons than everybody.
So still opportunities out there, just definitely more cautious. What's the biggest risk to this market right now?
Biggest risk to this market would be the Fed over tightening, not recognizing how bad the consumer is being damaged by these extreme rates. I'd say also that the Fed has this idea of getting down to a 2% interest rate. I'm not sure where that came from. As a financial advisor, I help people to plan their retirements with a 3% interest rate. So I'm not sure where we got to 2, other than that's what it's historically been here in recent years. But why can't we allow free markets to identify where this should ultimately end up? And I don't know, maybe there's a few ideas there.
3%, even that sounds a little bit ideal right now, with it still at 7%. We have to leave it there, but really appreciate your insights. Thanks so much for joining us here on the floor.
Thanks so much.
All right.